activity. Dalmia Bharat posted a mixed set of third quarter earnings. Sales looked good, coming in above expectations, but realizations were down about 5% quarter on quarter. The company has also seen an operational miss with Ebitda and margins failing to meet street expectations. Mr. Puneet Dalmia is Managing Director at Dalmia Bharat Group. He's joining us to take some questions. Mr. Dalmia, great to have you with us here. Appreciate you joining in. Prashant this side. You know,
Good morning, Prashant.
Where are we in terms of cement prices? Because we've been hearing that prices have moved up now. As compared to average Q3 prices for where you operate, how much higher are prices now?
Look, the fourth quarter is always better in terms of demand. And, we saw a very weak demand in Q3, especially November was a completely washout month. And I think we are seeing better demand now in this quarter. So usually, if I go by history, prices do correct themselves a little bit and they are higher in this quarter. But we have to wait and watch, how the market shapes up. But currently, I would say that we expect, based on history, that prices will be slightly higher this quarter as compared to the last quarter.
Okay, Puneet, good morning. The input costs still remain quite high. So what's the outlook on EBITDA per ton?
I think, there was a sudden spike in energy prices. And if you see petcoke prices almost doubled compared to last year, even coal prices have gone up by more than 50%. So there is an all-round spike in energy prices and input costs. We typically carry around 45 to 60 days of inventory. And I think on this, the worst is not over yet, because some of the high-cost inventory is going to get consumed in this quarter. So we expect the cost pressure to continue this quarter, but and if it starts cooling off, then maybe from Q1 of next year, we'll start seeing better thing on energy prices. However, we are doing a lot of work on improving our efficiencies, whether it is heat consumption, power consumption, or raw material costs. So I think hopefully some of this cost increase will get mitigated by the work that we are doing. However, having said that, there has been a sudden 25% hike in our variable cost year on year, and I think we will not be able to mitigate all of that, with the efficiency efforts that we are doing.
Okay, but that's quite concerning. You're saying, Puneet, that the cost pressures are not over just yet, and margins could fall further. I mean, this time around, your margins fell to about 15%. The expectation was 19%. So how much could it fall by? Because you are saying that on one hand, all the costs are rising. On the other hand, you're doing, things to improve efficiency. What could the ballpark range for margins be in FY23?
I think the good part here is that in this quarter, we expect better volumes. So part of our fixed costs will get offset by better volumes, and that should improve margins compared to the last quarter. Having said that, also, I think typically Q4 prices are slightly better than last quarter. So hopefully that should also mitigate the cost spike. So I would say, even though the costs are spiking up and the worst is not over yet, and some of the high cost inventories will get consumed this quarter, I think the margin should remain protected from here, or maybe slightly move up. But I think it will take couple of quarters to absorb this. And I've typically seen that when the cost increases are so high, typically in most industries it gets passed on. But it depends on demand supply, and I'm hopeful that demand should come back. There were a lot of issues with respect to rains, sand mining issues, labor issues, etc. I think they've gotten sorted out. We are seeing good demand growth in this quarter, and hopefully as demand improves, pricing should also improve a little bit.
So that just one more question, since we're talking about costs, your EBITDA per ton fell to about 700 rupees per ton, which was quite a steep fall, a 40% fall, I think, quarter on quarter. What could the average be for the full year and for the first half of the new fiscal?
Look, I think it's hard for me to project these numbers, but I would say typically, in this industry, we take a long-term view. There are blips along the way, but I think long-term, I'm still very optimistic. I think India has low per capita consumption. The market is consolidating. Entry barriers are rising. It's very difficult to put up new projects in India in a short period of time. So my view is that given entry barriers are rising, more consolidation is happening and demand is improving, the margins should stay above the 1,000 rupee EBITDA per ton number. There could be a few blips here and there, but I would say, 1,000 plus is something that I expect.
Puneet, for a lot of market participants, there's a question which is raised that what's going to be next Shree Cement. Dalmia Bharat's name comes to mind, but you need to scale up, right? Your current capacity is 36 MT, and I think you aim to reach by 110, 130 by 2031. So how much of this is going to be organic? How much inorganic? If you could give us some timeline as well.
Yeah, so I think we are delighted that we, started, the first plant in Maharashtra, which is called Murli Industries. It was, we bought it from in insolvency, and the plant was shut for almost 5 years, and we are really proud that we've revived it in a very short period of time. So that has started in middle of January, and I think our capacity now is around 36 million tons, 35.9 to be exact. We have, announced plans of going to 48.5 million tons by March 24. We are on track for that. And then we have announced plans for 60 million tons by March of 26. So I think as of now, our visibility is to 48.5 and 60 million tons. And our focus right now is on organic growth. There will be definitely along the way, this decade is a long period of time, and we will be open to inorganic opportunities provided they are at the right value and they strategically fit our aspirations. But right now the priority is executing this phenomenal organic growth that we have embarked upon. It's the largest capex in the history of the company that we are doing, and we are very excited about the future. I also think that we have clearly said that we want to maintain a strong balance sheet while embarking on this expansion, and our net debt to EBITDA will remain below 2 on this organic expansion. And even now, in the first 9 months, whatever capex we have done, our net debt to EBITDA is negative. So I'm happy that even though the company is growing, the balance sheet continues to remain very, very strong.
All right.
And I'm very optimistic about the future when I take a 3 to 5 year view.
Fair enough, Puneet. Thanks a lot for joining us. Always good talking to you. That's Dalmia Bharat. We need to take a break. By the way, LIC Housing